One common misconception I see when I'm working with new investor clients is related to financing. Most people who are ready to invest in commercial real estate are usually somewhat familiar with the home loan process. That's commonly because they might have already bought a home or two in the last few years and they remember the mounds of paperwork that go with it. Although there are a select few similarities, getting a loan for a commercial property is a bit different. First off, when you get a commercial loan for investment, you have to qualify as a borrower. You have to have money in the bank as reserves. You have to have down payment funds set aside. You will get asked about your credit report and any asset or liabilities you have and so forth. However, there's one huge key difference. A residential appraiser values the property primarily based on other sold comparables. The primary key difference is that even though comparables are considered with the commercial appraisal, a commercial property is valued primarily off the income it produces. So let's look at a property together, shall we? Here we're looking into buying an income property for $2 million. This income property makes $150,000 NOI, or net operating income after all expenses. On a side note, if you're a little unfamiliar with what net operating income is, you should check out my Investing Terms Part 1 video and get acquainted with the terminology and see how we come up with some of these numbers. Continuing on with our example, we know that based on a cap rate formula, with simple math, we will be able to make 7.5% on our money with no loan on this property. However, we plan on having a loan. The question is, will the property qualify? Let's presume that we check the rates and find out we can get a loan for 70% of the value at 7% interest, amortized over 25 years. With this, we'll have an annual debt service or mortgage payment of just about $119,000 a year. This brings our cash flow to just a bit over $31,000 a year, giving us a 5.21% cash on cash return rate. Now, this might be a completely satisfactory scenario to you as a buyer. However, the key difference you must be aware of is the debt coverage ratio, or DCR. The DCR is basically a calculation of how much your yearly mortgage payment is covered. For example, if you have a net income of $120,000 a year and your mortgage is $100,000 a year, your DCR is $120,000 divided by $100,000, or 1.2. This means you can pay 120% of your mortgage after all expenses. Now, all this may seem fine to you. You're buying the property because you plan on things running smoothly, and that extra 20% after your mortgage is pure profit, right? Well, here's the thing about investments. They don't always work out perfectly, and banks know this. So for the bank to protect itself, it might set a higher DCR for you to achieve. This way, if something happens and your income property isn't making as much money as you thought it would, the bank is still covered. Perhaps instead of a 1.2 DCR, the bank wants a 1.3 DCR. This means that the property has to make an additional $10,000 a year in order to work out for the bank loan. Of course, you could always pay less for the property, but for simplicity's sake, let's try to keep the numbers simple. Going back to our $2 million property example, we have an income of $150,000 before deducting about $119,000 a year for mortgage. $150,000 divided by our mortgage gives us a DCR of 1.26. During our talks with the bank, we find out that a 1.26 DCR is unacceptable. Instead, they want at least a 1.35. Now, there's a few ways to go about this. The first being you put down a larger down payment on the property. With another 5% down, we can surpass the bank's requirements and attain a 1.36 DCR. Also, we can pay less for the property. The last two options would be to get a lower interest rate or a longer amortization schedule. The DCR is definitely the key difference between a commercial investment loan and the home loan. However, there's still one other major difference, and that is the loan term. Most people who have bought a home are familiar with the 30-year fixed concept. You lock in your interest rate for 30 years and your payments never increase. However, commercial loans can vary. Because commercial properties are usually much, much higher in value than a home loan, the bank doesn't want to send an interest rate for 30 years. They'll miss out on too much money. What they do instead is they have a much shorter time frame, anywhere from 3 to 10 years. Now, they might amortize the loan over 25 or 30 years, but the rate they give you is not set for that long. You usually get a lower rate for a 3-year lock-in time frame. meaning that for the first 3 years, they can't change the interest rate. Then you pay a little more for 5 years, a little more interest rate for 7 years, and if available, even higher rate for 10 years. This again is when you really need to sit down and figure out what your future investment plans for the property are. So what happens after this 3, 5, or 7 year time frame? Well, one of two things happen. The first one is that after you lock in your time frame, the interest rate on the loan begins to float. What that means is that the rate can go up or down depending on the market. Of course, the banks can't just make this rate up. They tell you in advance. They'll usually say something such as, your new rate will be adjusted every year based on the 10-year treasury bill plus our profit yield of 3% with a maximum interest ceiling of 12%. This means that whatever rate the 10-year treasury bill is at 3%, and this will be your new interest rate. However, the interest rate they charge can never go over 12%. I go over this a bit more in my Where Are Mortgage Rates Headed video. The second thing that can happen is that after your lock-in time frame, you will have a balloon payment. A balloon payment is a large lump sum of the remaining balance you owe that you have to pay back to the bank. So if you have a 5-year lock-in time frame with a balloon payment at the end, you have to pay the bank back all of the remaining principal at the end of the 5th year, or the bank will take the property back regardless. Now, this might sound a little intense when you first look at it, but realize this is why commercial property is always being refinanced and sold so frequently, to satisfy these debts before they either float and go up or before the owner has to pay back in a huge lump sum. Again, this is why investing is considered advanced and a game plan needs to be laid out. Lastly, there's one key additional factor that comes into play when you're attempting to get a commercial loan, and that is the tenant leases. If you have an apartment, most leases are for 1 year, so it may not have as large of an impact as, let's say, a retail or office or industrial property. For example, if you have 4 different tenants in a retail strip center, but they're all small mom and pop shops on 1 or 2 year leases, lenders may be a bit hesitant. Compare that same scenario to having 4 different multinational tenants, such as a Baskin-Robbins or a Sprint store on a 7 or 10 year lease, and banks are going to feel much more comfortable with that. The reason is because the chances of a large company like a Baskin-Robbins or Sprint going bankrupt is so much less likely than a smaller mom and pop store. It's not to say it's impossible to get a loan with smaller mom and pop stores, it's just much more difficult, and it usually requires more down payment and a stronger buyer. When you're finally ready to start the commercial loan process, be sure to check with your lender or bank and see what is the common DCR range for the type of property you're thinking about buying. Also, be prepared for the type of loan they offer to give you, be it one with a balloon payment or one with a floating interest rate. You might not find the balloon payment as desirable as a floating interest rate, but what if the balloon payment the bank offers is at a much better rate for a longer extended period of time? Again, being prepared from the start is the best way for you to ensure you make the most of your investment. Now that's good to know.